You can pull bids, you can play games. They're not selling, they're buying. In fact, what they're doing is buying is just coming in. And we're talking about since the last 2 to 3 weeks, this fresh money, looking at the price of gold, looking at their other investments, noting its first tier, and it's these spreads that has drawn their attention. Otherwise, it might have just continued under the radar. So and most liquidity providers that face them and us assess it's going to require $3,500 to $5,000 gold price to bring enough gold to market just to bring the LBMA and CME into Basel III compliance. You know about this whole revaluation thing. It kind of went viral, and it really was instigated when the industry apologist, gold-hating Financial Times, they suddenly injected the idea that the newly appointed U.S. Treasury Secretary, Scott Bessent, may be considering such a U.S. gold price reevaluation. Now this was clearly something that had to be put in, and it was something that couldn't be hidden. And this discussion intensified after Bessent stood in Trump's office right on video and pledged to monetize the asset side of the U.S. balance sheet. And that was really, it's kind of to focus on assets as much as liabilities was kind of the spin, and while also promising to lower 10-year treasury yields. And since the gold revaluation mantra has now gone fully mainstream, underscored last week with a Bloomberg intelligence interview with the Bank of America revealing that this gold revaluation process is underway. Now, these are planted to actually create a backdoor now. And I'm not talking about a rinse here. We're talking about the necessity to revalue. And we'll explain why and how shortly. But now currently, if you think about it, Treasury gold is valued currently at $42. And okay, so if we revalued at today's price, well, actually we were above 2,900. We've just made all-time highs again, despite attempts to knock it back down. So even if you picked arbitrarily 2,900, that would inject around 900 billion into the Treasury General account. That would be via repurchase agreement. Now the suggestion, as this may offset the need to issue quite so many Treasury bonds this year, so from a high level. But now if planning to issue long-term gold-backed bonds, well, why not 3,000 or 5,000? So, why not is the question. And as we looked at in our last episode, the embedded paper to physical exchange for physical spreads, what they do is telegraph the US as represented by cash-settled COMEX market, that is, has to become Basel III NSFR compliant, meaning it has to be physically backed by the 1st of July deadline to comply, or it's going to have to fold. And it's not going to fold.
Now that the revaluation narrative has not only surfaced but hit mainstream financial chatter, the tempo has shifted from quiet accumulation to what I would call pre-positioning for systemic transformation. You see, when even the most gold-averse media outlets begin running speculative headlines about repricing U.S. Treasury gold, we're no longer in conspiracy territory. We're in the preliminary stages of policy maneuvering. And let me be very clear with you, when gold is revalued, not if, but when, this will not be some minor monetary footnote. This is about rewriting the script of global monetary dominance, pivoting away from an exhausted debt-based fiat regime into one that is asset-backed, transparent, and rooted in the immutable truth of physical reserves. Now here's the part that most of the public doesn't grasp. The current Treasury-held gold is still booked at $42.22 an ounce. You heard that right, $42 and change, despite gold trading around $2,900. This is a relic valuation from the Bretton Woods era. The gold hasn't moved off the books, but its real value certainly has. And what does that mean? It means the U.S. Treasury has trillions in hidden equity sitting silently on its balance sheet. Every $4,000 rise in the price of gold injects a full $1 trillion into the Treasury General account, free and clear. That's not hypothetical, that's policy math. Now imagine if gold is repriced at $10,000 per ounce. We're talking about trillions suddenly available to shore up debt, fund infrastructure, and regain investor confidence in the US dollar and treasury markets. But this goes beyond liquidity. This is about reclaiming fiscal sovereignty, and it doesn't even require congressional approval. That's right. Under the current framework, all that's needed is an executive directive. Tell the Fed to revalue the gold, and just like that, it's done. A simple bookkeeping adjustment with monumental implications. But let me tell you where this gets even more fascinating. It's not just about the US playing catch-up. The global central banking community, those in the know, have already seen the writing on the wall. For the last 3 years, central banks, particularly those aligned with the Global South and the BRICS bloc, have been buying physical gold at record levels. In fact, net central bank gold purchases have been at historic highs. They're not doing this because they're gold bugs. They're doing it because they know the next monetary system won't revolve around the dollar. It will revolve around a basket of commodities, and gold will be its cornerstone. You think it's a coincidence that China, Russia, India, Turkey, hell, even Poland and Hungary are all repatriating and stockpiling gold? These are moves made by institutions preparing for a systemic reset. And while Western populations remain distracted by speculative assets, meme stocks, and AI exuberance, the biggest money in the world is positioning into tangible wealth, into gold. And here's where things become truly urgent. We've seen that the bullion banks, the usual suspects, are scrambling. Why? Because they're short gold in a market that is rapidly moving against them. They're trying to suppress the price, issue paper contracts, and delay deliveries. But the game is up. Physical demand is exploding. Exchange for physical spreads are blowing out. Refinery delays are extending up to 12 weeks. There's not enough bullion to meet contractual demand, and the credibility of institutions like the COMEX and LBMA is being questioned like never before. Meanwhile, more and more institutional players who had never before touched gold are entering this market. These are not speculative hedge funds trying to scalp $50 swings. These are sovereign wealth funds, insurance companies, and pension managers waking up to the fact that there are no real returns in bonds, and there is mounting risk in equities. Gold suddenly isn't just a hedge, it's a necessity, it's a lifeboat. And then there's the quiet but undeniable movement of ETF redemptions. Large-scale holders are cashing out their GLD and SLV positions, not for dollars, but for the underlying metal itself. This isn't retail FOMO. This is strategic repositioning. If they were just profit-taking, they'd sell and move on. But they're taking possession of metal. Why? Because they don't trust the system to make good on paper promises. This is the canary in the coal mine, folks. And let's address the elephant in the room. Will they confiscate gold again? In my view, no. They won't need to, because the gold they need is already in the ETFs, in the vaults, held by the custodians who work hand in glove with government entities. All it takes is a Friday evening memo. We're closing the fund, converting positions to cash, and Monday morning, that gold is gone. Legal, efficient, done. You still own dollars, but they now sit in your money market account, no longer backed by metal. Friends, we are witnessing the biggest monetary shift since the collapse of Bretton Woods. It is being carefully managed, selectively disclosed, and quietly implemented. The only question left is, are you prepared? Do you hold your gold physically outside the banking system? Because when this revaluation hits, and it's not decades away, it's months or even weeks, those with paper claims will find themselves on the wrong side of history. Don't wait for the mainstream to tell you it's real. By the time they admit it, it will already be over. You must decide now whether you're going to be part of the few who saw it coming, or among the many left holding the bag. This is Andrew Maguire, and as always, I'm telling you what I see, whether the mainstream likes it or not. Stay prepared, stay sovereign, and stay golden.
Now, the paper to physical EFP spreads have expanded because shorts, well, simply they're unwinding their bets. And while this should be allowed to kind of play out, this undersupply is too large to square at current prices. It's pretty much that simple. In fact, with shorts competing to buy back underwater bullion leases. Now, bear in mind, you borrow gold or you lend out gold, you get a return, somebody buys that gold and sells it and tries to, obviously their incentive is for it to not to rise from that point. But they're going to have to, because it's risen, they're going to have to buy back these underwater bullion leases against global central banks and fresh, as yet untapped institutional gold buying that's coming in. These are people that have never bought gold before, which has expanded this, and as this open interest comes in, people say, oh, well, yeah, hang on, look at that speculator open interest. That's easy to rinse out. I'm sorry, no, they're coming in. They've never been in before. This is not rinsable. This is what we call the sticky category of speculator open interest. You can pull bids, you can play games. They're not selling, they're buying. In fact, what they're doing is just coming in. And we're talking about since the last 2 to 3 weeks, this fresh money, looking at the price of gold, looking at their other investments, noting its first tier, and it's these spreads that has drawn their attention. Otherwise, it might have just continued under the radar. So, and most liquidity providers that face them and us assess it's going to require $3,500 to $5,000 gold price to bring enough gold to market just to bring the LBMA and CME into Basel III compliance. And so really to answer a slew of fresh subscriber questions, this week I'm going to expand on how an impossible to avoid global gold price revaluation is expected to actually roll out. And with Senator calls now for Doge to conduct a full audit of Treasury gold and empirical evidence of multiple ownership claims on the Fed-managed portion of the US Treasury gold. When it's revealed, this mismanagement of gold assets may end the Fed as we know it, and at what price this revaluation is likely to be anchored into the various scenarios that we look at. Now, but blindsided by the race to bring physical gold into the US, what it does is expose the LBMA CME physical delivery default, which is occurring under our noses in London. And not even the Bank of England can address this, supply enough bullion to address this. Instead, paper gold warrants for future delivery are being issued instead of bullion in an attempt to buy time to deliver. In fact, these paper gold contracts are coming at a discount because nobody wants them anyway, because they are not going to get delivery of them. However, because these are forward contracts, if it was an FX contract, it'd be deliverable. There's a lot of gaming going on here. However, this has driven, all of this has done is driven an even larger race to buy bullion before gold is revalued.
The conversation around gold revaluation is no longer confined to niche corners of the financial world. It has emerged front and center, particularly as even mainstream financial institutions begin to acknowledge what many of us have been warning about for years, that the paper gold market has been hollowed out by years of synthetic overleverage, and the physical market is now calling its bluff. And let me make this absolutely clear. We are witnessing a foundational transition from a world of promises and IOUs to a world that demands the real thing. The gold that matters is the gold you can touch, weigh, and store, not the gold represented by digital ticks on a terminal backed by some offshore custodian's ledger. Now, when we look at what's really going on in these gold markets, you need to start by understanding how manipulated these structures have become. For decades, bullion banks, acting in concert with central banks and under the regulatory blindness of Western governments, created a paper construct so bloated and so far removed from the underlying physical that it was essentially functioning like a Ponzi scheme. You lease out an ounce of gold, sell it, then lease it again from another party. Rinse and repeat until you've created a multi-tiered paper pyramid with only a small amount of actual gold underpinning it. This worked fine when trust in the system was intact. But trust is a fragile thing, and it's collapsing. And the collapse isn't theoretical, it's happening in real time. Look at the exchange for physical, EFP market, where gold contracts from the COMEX are supposedly converted into physical deliveries via the LBMA. For years, this mechanism masked physical shortages, but now those spreads have blown out to historic levels, signaling massive strain. The COMEX is essentially being forced to acknowledge that gold promised on paper isn't available on demand. They've started issuing forward delivery contracts months out just to buy time. These aren't settlement contracts, they're stalling tactics. And believe me, the smart money sees it. That's why you're seeing massive withdrawal requests, even in cases where the bullion banks claim the gold is safe and allocated. Meanwhile, the Bank of International Settlements, the central bank of central banks, already got out of the paper gold game. In late 2022 and into 2023, they closed out hundreds of tons in swaps and leases, basically saying, we're done playing this game. Why? Because Basel III regulations have changed the stakes. Gold is no longer a risk-weighted Tier 3 asset, it's Tier 1 now. That means central banks holding gold outright, fully allocated, physical gold, not a paper claim, can count it at full value on their balance sheet. That alone tells you everything you need to know about the future of monetary stability. So what happens next? Revaluation? But not because someone wakes up one day and decides gold should be $10,000 an ounce. It happens because the system has structurally failed. There's no going back to paper promises. Central banks know this. That's why they're repatriating gold at a record pace, especially from the Bank of England and the Federal Reserve Bank of New York. That's why the so-called monetary authorities are suddenly very interested in conducting audits of their gold holdings, despite having refused to do so for decades. When politicians and technocrats start muttering about audits and transparency, you know they're preparing for something seismic. This revaluation isn't just about solving a technical imbalance in the markets. It's about a complete reset of monetary confidence. You can't print credibility. The US dollar, like all fiat currencies, is rapidly losing its ability to command trust globally. Just look at foreign central bank behavior. Dumping treasuries, accumulating gold, setting up bilateral trade agreements in local currencies, and building out their own central bank digital currencies, CBDCs. They're preparing for a world where the dollar is no longer the fulcrum of global finance. And the only asset that transcends these transitions, the only true neutral reserve asset that every nation can agree on, is gold. Now, what does this mean practically? It means we're heading into a period where physical gold supply will become extremely tight. We've already reached that point. We're seeing refinery delays stretch out 8 to 12 weeks or more. Major mints are either rationing product or backlogged. Premiums are starting to move up, albeit gradually for now. But once the general public wakes up to this shift, you're going to see a scramble unlike anything in recent memory. This isn't about trading. This is about survival. When gold is revalued, it will not be because of speculation. It will be because there was no other choice. Let's talk numbers for a moment. The U.S. Treasury still values its gold at $42.22 per ounce, a relic of the Bretton Woods system. If that gold were revalued to current market prices, say $2,900, that would instantly inject close to $900 billion into the Treasury General account without needing to pass a single bill through Congress. If revalued to $5,000, that's over $1.5 trillion in fresh liquidity, money that can be used to pay down debt, issue new gold-backed bonds, or restore credibility to the balance sheet. And if you believe insiders like Judy Shelton and others whispering about gold-backed treasuries being launched in time for America's 250th anniversary in 2026, then this is no longer theory, it's strategy. Furthermore, what we're seeing with gold isn't isolated. Silver, the monetary metal's twin, is still flying under the radar. But not for long. The gold-to-silver ratio remains near 90-to-1, an historically unsustainable level. Silver is both a monetary metal and an industrial metal, and it's in a structural deficit. Once the revaluation in gold happens, silver will move aggressively. We've seen this movie before. In the late 1970s, as inflation spiraled out of control and gold soared, silver surged by a factor of 10, from under $5 to nearly $50. History doesn't repeat, but it often rhymes. So what can you do? First, understand that your wealth is not safe in digits on a screen. Those digital entries are promises, and promises are only as good as the people making them. We're entering a world where counterparty risk will be the most important metric of wealth preservation. Second, own physical, not ETFs, not unallocated accounts, not digital, gold-backed cryptos that rely on custodians. real physical bullion. In your hands, outside the banking system. And lastly, understand that this transition is not linear. It happens slowly at first, then all at once. We're not predicting a gold standard 2.0. That's not what's happening. What we're witnessing is the end of trust in fiat alone. Governments and central banks will need to anchor their currencies to something real to restore faith. And that anchor will be gold, revalued, transparent, verified, and finite. The sooner you get on the right side of this transition, the better position you will be, not just to protect your wealth, but to thrive in the system that emerges from the ashes of this one. Because make no mistake, the ashes are coming. Whether by inflation, debt collapse, bond market breakdown, or geopolitical conflict, the global monetary order is shifting, and gold once again is stepping into its role, not as an investment, but as the foundation of trust, stability, and sovereignty. Ignore it at your own risk.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.